Hello, this is Professor Hazara again, and this is the second of the videos on business combinations. This video, I'm just going to very quickly go over the last situations that we had in the slideshow. In the slideshow, I finished last time and I said that there are four situations that we have to consider, and one is a liquidation. You liquidate a business and you result in goodwill. Liquidation with bargain purchase option. No liquidation with goodwill, and no liquidation with bargain purchase option. This first one is really the base for all this. If you understand this first one, in a sense, you'll understand the other three. But we got to get into this right away before my computer runs out of space here. Okay, so let's go to the spreadsheet. We have four situations. Okay, this is going to be a business combination, and this is going to be a liquidation with goodwill. Okay, and I'm just going to get right into the situation here. Okay, you have a company. This is going to be the same. I'm going to use the same example four times basically. Okay, so on January 1, 2009, you have a Pelican Corporation that's the parent, always begins with a P, enters into a business combination with Seabird. Seabird, you'll always see that the acquired corporation always begins with an S because it's subsidiary. So Pelican's the parent, Seabird is the subsidiary. Pelican pays $825,000 for Seabird. The consideration consisting of 33,000 shares of Pelican par $10 par common stock with a market value of 25. Okay, and so they're acquiring 100% stock of Seabird Corporation, and Pelican pays $825,000 for this company. Okay, and if you take 33,000 times 25 per share, you'll get $825,000. In addition, here there's some costs of the merger, and they total to $140,000. Well, I'll show you how to handle those costs later on in the video. But we're going to expense all those as part of the acquisition. Those will all be expensed. Okay, so here's what we got. We have got, you've got, what this example gives you is it gives you three balance sheets. There's a balance sheet. There's cash, accounts receivable, inventories, land, buildings, equipment, total. This is the parent. It's got a larger balance sheet than the subsidiary. So you've got a balance sheet of 2.8 million versus 760,000 Seabird. But notice that you've got three balance sheets. One for the parent, that's book value. BV is equal to book value. So you've got a book value balance sheet for the parent, a book value balance sheet for the sub, Seabird, and then you're also getting, you've got a fair value balance sheet for the sub. Now, the fair value balance sheet for the sub is necessary because, as I said in the previous video, that an acquired company is always valued at fair value. Okay, so anyway, so there's going to be three steps in this valuation. I'm going to go through them rather fast, but I hope it makes some sense. Okay, step one is we're going to compute the goodwill, and that's what I said in the previous video. You have to do a valuation and see if you come up with goodwill or a bargain purchase gain. Okay, so we're going to compute the goodwill. Okay, then we're going to prepare journal entries on the books of the parent. There's going to be three entries. One to record the investment. Next one is to pay the cost. Those are easy. But the key one is going to be to liquidate the other company. Now, this is a choice. You can either liquidate or not liquidate the other company. The assumption in this example is, like I've said, is we're going to liquidate. Okay, so let's start with the calculation of the goodwill. Okay, and this is the way I do it. A lot of people do it differently, but I think this is the best way to do it. Okay, we're going to start with the cost of the investment. Okay, and this is the cost of the investment to the parent. So all these are calculations that are done by the parent so they can record entries on their own books. Okay, so anyway, so the cost of the investment is going to be, the cost is always fair market value. The cost of any investment, here's the rule. Cost is equal to, I'll put it out here actually. Cost is equal to fair market value of stock issued. So if the parent issues stock, it's the fair market plus cash paid. So if you pay cash, that's it. If you issue stock, it's the fair market value of the stock. If it's both, then it would be the combination of both. Okay, so we'll put it right here. And they issue, if you go back, 33,000 shares with a fair value of $25 per share. Okay, so we'll do this. So we'll put this one in the middle here, right here. So they issue 33,000 shares, and each share has a fair market value of $25. So the cost to the parent is equal to 33,000 times 25, $825,000 is the cost of the subsidiary to the parent. Okay, and so the next step, so that's step number one. The next step is we have to compare the cost with the net book value. You have to compare it with the net book value of what you're buying, because you're buying stock. You're buying a bunch of stock. You're basically buying all this stock from the other company. You're buying all this, which is equal to their net assets. Net assets are assets minus liabilities, okay? And so that's also equal to shareholders' equity, so it's basically stock. Okay, so the net book value of the other company is going to be the sum of, first you got their common stock, then you've got their additional paid-in capital, and then finally you've got their retained earnings. Okay, so here's what we're going to do. We're actually going to take the cost and we're going to subtract out the net book value of the other company. So we're going to subtract out, in parentheses, 300,000 plus, just a minute here, let's make sure we get this right. This is 50,000. Okay, so we're going to subtract out 300,000 plus 50 plus 170. Okay, so that's 520. So you're overpaying in this case. You're paying a cost of $825,000 minus a book value of $520,000, and that's equal to 825 minus 520. You're overpaying, excuse me, let's get this right. You're overpaying by $305,000. Okay, now here's the question in the Goodwill calculation. You've got to ask yourself, you're overpaying by $305,000. Why are you overpaying? Well, there's two reasons. One reason you overpay is because a lot of the assets that you're buying, so you have all these assets up here. You have some cash, you have some accounts receivable. A lot of these assets might be worth more than their book value. Okay, so inventories has a fair value of 120 versus a book value of 80. You're going to pay 120 for that. You're going to pay 150 for the land versus a book value of 100,000. Same for the buildings. You're going to underpay a little bit for equipment, but this overpayment, part of it is attributable to tangible assets which you're paying, which have a fair value greater than their book value, so you're overpaying. And some you might be underpaying for it. And any part, so we're going to try to identify tangible pieces of assets or tangible assets for which their fair values differ than their book values. That's one of the reasons you might overpay. Any part of any asset and any leftover is goodwill. Goodwill, by definition, is the part of this payment that you can't identify with any specific asset. Okay, now here are some rules that we're going to have. First of all, we're going to start with, we're going to have a column here, and I'm going to put that, label that column as fair value. Then I'm going to label the next column as book value. Okay, and what I'm going to do is that for each one of these assets, I'm going to take their fair values. They're in reverse, by the way. I'm only going to put in assets for which the fair value and book value are different, because I'm going to take the difference, and if the book value and fair value are the same, it won't matter anyway. So for accounts receivable, so we're going to start with accounts receivable. Accounts receivable, a fair value of 40 and a book value of 50. So it seems to me that you're underpaying for accounts receivable. That would mean a reason why you're underpaying. Inventories has a fair value of 120 and a book value of 80. Land has a fair value of 150 and a book value of 100. Buildings has a fair value of 300 and a book value of 200. Equipment has a fair value of 250 and a book value of 300. Okay, now we have to not only do that for the assets, we also have to do it for the liabilities, because you can't buy a company's assets without buying your liabilities. Nobody's going to let you do that. Okay, so accounts payable is the same, so that's not going to make a difference anyway. So the only amount that's different for liability is the fair value of the notes payable is $200,000, and the book value is excuse me, gotta make sure I got these right here. The fair value is 180, and the book value is 200. I just want to see that I've gotten these all correct here. 50, 80, it's very easy. 200, 300, 200, and then 180, 250, 300, 50, and 40. Okay, so these are fine. Now we're going to take the difference. We're going to take the difference of the fair values and book values. And what we're going to do for assets, here are the rules. If the fair value is greater than the book value, subtract the difference. If the fair value is less than the book value, add the difference. That's for assets. Now for liabilities, if the fair value is greater than the book value, you do the opposite. Then you add the difference. If the fair value is less than the book value, you subtract the difference. That is correct. Okay, so we got a situation here where the fair value for an asset, this is an asset, is less than the book value. And I'll talk about why as we move on here. So what we're going to do is we're going to take the we'll just take 50 minus the 40, so we'll get a positive $10,000 there. Okay, so if the fair value is less than the book value, add the difference. Okay, and I'll talk about one thing. Now, if it's less, if the fair value is greater than the book value, then subtract the difference. That's negative 40. Once again, for land, the fair value is greater than the book value, so subtract the difference. That should be a negative. Then for the building, the fair value is greater than the book value, so we will once again subtract the difference. The equipment, it's an asset, and so we'll apply this rule here. If the fair value is less than the book value, we will add the difference. So we will just take 300,000 minus 250. We'll just reverse that right there. We'll add the difference there. And then finally, it's the only liability we have. And so for this liability, the rule is for liability, if the fair value is less than the book value, subtract the difference, which is the opposite you do for assets. Okay, so we will just do this. Try again. So I've got a difference of 305,000. I've got all these differences that can be associated with assets. Now think about this. You overpaid by 305. Of that 305, part of that 40,000 was due to the fact that inventories were valued great, or had a value of 40,000 greater than their book values. So of this 305, 40,000, a $40,000 piece is due to inventory. A $50,000 piece is due to buildings, because you're paying 300,000, not 200,000 for the buildings. So you overpaid. Part of that 305 is 100,000 for the buildings. And note payable. Think about this: if the fair value of a note is less, if the fair value of a note is 180 and the book value is 200,000, that means that the note, that the value of your company is actually greater because it's a liability. You really owe $20,000 less than your book value of the note. That means your company is worth more. So in a sense, what you're doing is you're subtracting amounts that cause the net assets that your company to be worth more. If your assets are greater, like in these three cases, your company is worth more. If your liability is less, your company is worth more. So you're subtracting out, this difference is an overpayment. These 4 red things, negatives, are reasons why you would pay more. And the 10 and 50 are reasons why you would pay less. Anyway, so what we're going to do is we're going to underline this part right here. And we're going to go ahead and add just sum these amounts up here. And we have goodwill. Our goodwill is $55,000. So we overpaid by $55,000. Okay, and what we're saying is that of this 305, we identified 6 or 7 reasons tied to specific assets. The amount that you could not identify of the 305 overpayment, the 155 portion of that overpayment, is goodwill. It's really the part that you can't identify with anything. Okay, now the next thing to do is we're going to go down here and prepare journal entries. And these journal entries I should put in red here. These journal entries are all on the books of the parent. They're all in the books of Pelican. Okay, so the first thing that Pelican is going to do is Pelican is going to record its investment. Okay, and this is going to be a debit. And the debit to the investment it always has to be for the cost of the investment. So it's always, in this case, it's for 825. It has to absolutely be, these 2 numbers should always match. There's no question. Those 2 numbers should always match. That 825 right there. Okay, common stock. Common stock we issued, I'm just going to do this. There's the calculation. We issued 33,000 shares. Each one has a par value of $10. We issued $330,000 of common stock. And then the difference, as you should know from 312, just goes to additional paid-in capital. That's the first thing. Okay, the first thing, so we have an investment on our books. You could call it an investment in Seabird or whatever the name of the company is. But we have an investment worth $125,000. That's an investment in stock. So that is an investment in stock. Okay, now the costs. The costs are, when I say costs, all these are like lawyers' fees, accountants' fees, and all those things that you have to pay when you do a merger. And the total of those was $140,000. So I'm just going to go ahead and take that out right there. Okay, so you've got 2 journal entries. One is you invested in stock. This is a recording. This records your investment in stock. And the way you bought it is you issued your own shares to their company's shareholders. And those were worth $825,000. And then you paid some legal fees to accountants and all that. We always expense those on the books. Now, the third entry is going to be to liquidate the other company. Now, the third entry is the one, it is to liquidate. I'm going to try to put this in bold here. But the third entry is to liquidate the other company. And by liquidate, we mean that what you're going to have to do is you're going to have to bring over all the assets of the other company and liabilities at their fair market values, put them on your own books, the other company goes out of business, and you have one company left. Okay, so let's go ahead and just start bringing over all the assets and liabilities of the other company. Okay, we'll just list them out. So we know, let's go back to the balance sheet here. We know that you got some cash. Okay, let's see what we got here. You know you got some cash. We know that you have some, you're going to bring over some accounts receivable. I'm just going up. I'm just going to go ahead and we know that you're going to have some inventories. Have some inventories, and then you have some land, buildings, and equipment. So you're going to have some land here. You're going to have some buildings, and you're going to have some equipment. And then, so that takes care of inventory and building equipment. I'm going to leave a blank space, and then you also have to bring over the liabilities, and then write off the investment. So we're going to bring over. Next thing we're going to bring over is we've got to bring over the liabilities. These are going to be credits because there's only one liability, which is note payable there. Okay, so I guess we'll try to move this over. Yeah, we can move that over. Oh, guess not. I'm just going to write it in note payable. Okay, and then believe it or not, what we're going to do is we're going to write off this investment here. And so what we're doing is with this entry is we're liquidating another company. So we're throwing our stock in the garbage can. That's why we're going to actually write off the investment part. We're going to throw the stock in the garbage can, and we're going to take that investment and we're going to replace the stock with the individual assets and liabilities. Okay, and they have to be brought over at fair market value. Keep in mind that all these entries are on P's books. I can't repeat that enough. So let's go ahead and bring over all these assets and liabilities, and the one liability over their fair market values. Okay, so cash has a fair market value of 30. Accounts receivable has a fair market value of 40. Inventories has a fair market value of 120. Land has a fair market value of 150. Buildings has a fair market value of 300. Equipment has a fair market value of 250. Now, those are debits. Now, let's get the credit in. Notes payable has a fair market value of, let's see here, 40. By the way, I should have definitely brought over accounts payable here. So let's go ahead. I'm going to go ahead and just move these down one row. I'm going to put accounts payable right here. Because even though it was equal, you're still buying it, and you have to value it at its fair market value. That's going to accounts payable should be. So accounts payable is equal to the fair market value of accounts payable is equal to 40. So I've got, it looks to me like I've got all the assets, liabilities, 30, 40, 120, 150, 300, 200. There's your investment account. Final thing I'm going to do is I'm going to write off the investment account. I had a debit there. Now I'm going to zero that account out. And the reason I'm zeroing it out is because if I decided to not liquidate, then I would have kept the stock. But since I'm liquidating, I have to throw the stock away. Now, if we add these up, we're going to get here 890 on that side. And if we add these up, we're going to get 1045 on that side. The thing that's missing is, in fact, the goodwill. That because we paid more for the company's net assets, we have to plug goodwill in here because that goodwill is buried in that 825. As you can see, it was part of the 825, which we broke down as equal to 155. So we've got to go ahead and put goodwill into this calculation here. And then we should, with any luck, balance. We do balance. Okay, so those are the entries. So step one, compute goodwill. Right there. Step two is, I can put that in red too. Step two is prepare the journal entries on the books of the parent. Parent is buying some stock and then liquidating the other company. Final thing is prepare a new balance sheet. Okay, and so hopefully I'll have enough time in my computer room or other space. That's why I'm going a little fast on this one. Okay, so what I'm going to do is I'm going to take all these entries which were on the books of the parent, and I'm going to go ahead and start with entry 3, and I'm just going to go ahead, reference the entry here, do debit credit, and add across there. Okay, so I'm going to start with entry 3. So entry 3, you're going to have a debit to cash for 30. So you're going to have on the parent's books, you're going to have a debit to cash for 30,000. Okay, and then in entry 3 also, it's the one that takes up the most space. That's what I'm doing first. Also, accounts receivable is 40. By the way, you may ask where I'm getting, the parent's book value from, balance sheet from. It's just the balance sheet I had up here. These are the same balance sheets, 2.8 million and 2.8 million. I just copied it down because what the parent is doing is taking its own balance sheet, buying another company, and then merging the two, and then throwing the stock away. Okay, then 3 here too. There should be a debit here to inventories for 120,000. Then 3 here. There should be a debit to land for 150. There is still entry number 3. There should be a debit to buildings for $300,000. I'm bringing over their fair market values. You should notice that. And then there should be a debit to equipment also. These are all from entry number 3. By the way, that's why it says entry 3 right there. That's what it is, entry 3. Debit to equipment for $250. Okay. Place. And then debit to equipment for $250. I'll get to the Goodwill later. Then there's going to be a credit. This is from 3. These are both from entry 3 also. Then there's going to be a credit to accounts payable for $40. There's going to be a credit to notes payable for $180. Capital stock. Notice there's no entries here in entry number 3 to capital stock. I'm almost finished with this. The only things that I've got left over is I've got a credit to the investment account for $825. So I'll go ahead and credit the investment account for $825. And you know there's a debit way up in entry 1, so that'll zero out. And then I've got a debit to Goodwill in entry 3 here. I've got a debit to Goodwill for $155. I'm going to do a quick total here. Make sure that my debits and credits are balancing. I'm almost finished here. It'll be a shame if 1045 and copy is 1045. Okay, so they also came from entry 3. The other 2 entries are very short. The first one, I could have done this one first actually, but I wanted to get the long one done. I've got, in number 1, I've got a debit to the investment for $825. So I'll just put here, I'll put 1, 3. That's a debit to the investment for $825. Okay. And then I've got credits. This is stock I'm issuing. This is stock that it's stock that Pelican has issued to Seabird shareholders. $330 to common stock and $495 to paid in capital, and those are all entry to additional paid in capital. Those are number 2 and number 2. So common stock, we've got a credit to common stock for $330. And we've got a credit to additional paid in capital for a rather large amount, I think $495. Okay, so my debits are equal to my credits. Notice what's happened in the investment account. I bought the stock and I threw it away. And I'm replacing, this will be 0, I'm replacing the stock with the actual fair market values of the assets and liabilities. So I'm replacing one number with the actual investments that make that up, including, by the way, the Goodwill. Okay, the final thing is I've got some expenses. Now, the best thing to do is just put expenses into retained earnings, because expenses always reduce retained earnings. So we'll go ahead and do expenses here. This is from entry number 2. So we'll debit retained earnings for expenses. So there's its expenses, and then we paid cash on those expenses. So I'll call this 3, 2, because a credit comes from entry 2, and so we're going to have cash, a credit to cash for an entry 4, $140,000. Okay, now I'm just going to go ahead. I'll put total here. I'm just going to go ahead and total my balance sheet totaled. And by the way, I'm just going to repeat, that balance sheet came from this book value balance sheet here. Okay, and here we're going to go ahead and total these assets. Remember that assets go up with debits and down with credits. So here are the totals. This is equal to cash of $150 plus 30 minus the 40. So my final cash balance should be $40,000. And what I'm going to do is I'm just taking the original balance plus the debits minus the credits. And since those are all, the logic is going to be the same, I'm just going to go ahead and put those down. Okay, so every one of these is the original balance plus the debt minus credit. Let's see what I get for the total here. Total assets is equal to 3,705,000, and that is correct, 3,705,000. So you've got one company now with assets of 3,705,000. I'm going to finish with my liabilities and shareholders' equity. Start with the original balance, add the credit because liabilities go up with credits, and then take that down. Okay, so 340 is the balance there, and then I'm just going to go ahead and copy this amount down to right here, all the way down here, 360, and then I'm going to see if those sum up to my assets. Then I'll go over a couple of points. This has been fairly quick, I know. 3,705. So my two asset amounts right here, asset equal liability and shareholders' equity. Now keep in mind a few things. This was a little fast, but keep in mind a few things. I'll talk about 2 or 3 more minutes. Number one is this was the original balance sheet. You had one company. You bought the other company. You bought Seabird here. You bought this company here, but brought all its assets and liabilities over to your own books at fair market values. So the logic is you bought the stock, and you paid, this is what you paid for it, you issued your own stock to the shareholders of Seabird, you paid these expenses, but the most important journal entry is this one right here. This is where you took the stock you bought, $825, and literally threw it in the garbage. That's why that credit right there. So you take the stock, throw it in the garbage, and you bring over, you replace the one line of stock, which is $825, which is made up of, there's the $825, it's made up of all these differences and the goodwill and assets and liabilities for which there is no difference. But anyway, so you throw the stock away, you brought over all those assets and liabilities at their fair market values. Keep in mind, I picked up all these fair market values from the fair value column right here, basically. So you brought them all at fair market values. Because you brought them all at fair market values, and the fair market values don't necessarily balance, you have the goodwill in there. And so the acquisition itself created goodwill. The acquisition itself created goodwill of 155. Okay, and so you end up with one large company, which is Pelican, which is what I said in these PowerPoints over here. Remember I said in this PowerPoint here, you have company A, which is Pelican here, company B, and you up with Pelican, which is a lot more because you took the other company, bought all its stock, threw the stock away, and decided you just wanted to bring over its individual assets and liabilities. Usually this type of acquisition is done in a bankruptcy. Anyway, so that's this first video here. I will put this one up, and then the others, actually, we're going to repeat. I can go through this fast because in the next one, we're actually going to repeat this again, but we're going to have you're going to have a bargain purchase option in this one over here. Obviously, I've already done these. I'm just redoing them so you can see how it's done. Anyway, so hope everybody's staying safe. And I'll put this video up, and this will be number 2 in the series of videos. Thank you very much.